Hi, good evening, ladies and gentlemen. Are you able to hear me? If you can you type yes in the comment box? Thank you, Kim. Thank you, Joe. Okay, so I assume the rest can hear me. All right, so welcome to a session where I'm going to share about stock investing, and the purpose is to give you all a better idea if you guys are looking at to invest on your own, and what are things that you should know, what are things that you should look out for. And for today, I want to do a little bit of do a bit different from what I usually do. Right, I did prepare quite a lot of slides for today, but I don't want to just follow the slides, and I want to keep it more interactive and more free flow. So especially if you have questions, right? So I want to make this session more dedicated to you, right? So if you have any investing questions or queries that you want to find out, you want to learn, and I'm going to dedicate 1+ hours to address your questions, right? So let's try to do it differently rather than I go through the set of slides that I prepared, because some of them may not address the concerns that you might have or some things that you want to know or learn. So I want to make it more tailored to you today. Okay, so that's the special session for you. You can see that I even created empty slides for me to write, so there are more space. Before we begin, maybe I just want to give you a little bit of the thinking of investing in general. Then maybe you can start from there. You can ask your questions. Okay. So the first thing that I want to share with you is there are many methods or strategies to invest in the market. Okay, some people talk about you should not buy stocks, you should just buy ETFs. Don't beat the market. You should just buy the entire market, buy index fund, buy and hold. Some people think of things like buy and hold as a long-term investment. And some people will tell you that, oh, market crashes are very scary, so you need to know when to sell. A lot of people know when to buy, but don't know when to sell. So they just keep holding and holding. Some people will tell you that, oh, you should do value investing because that's what Warren Buffett does, and that's what it's quite an effective strategy for a very long time, right? It's a very good track record. Some people say value is there, you should do growth investing, right? So there are many different ways to invest. And I think in today's context is that it's confusing for a lot of, especially beginners, because you might be thrown in the deep sea of this stock market, and then you hear a lot of differing views, and social media is full of differing opinions. And that is the problem or the state of investing today as compared to, say, 20, 30 years ago. The lack of social media present the other side of the problem, right? You don't hear a lot of information. You don't get a lot of information. In fact, a lot of the information you get is very outdated, right? Even the share prices you check via your broker, you need a call, or you have to check the teletext, which is 15 minutes to half an hour delay. You don't get to go to the internet to search for the latest news or events about a company, right? So it was a totally different kind of change as compared to what we are experiencing now. So now what you're probably facing is overwhelming information. Okay, so that's the other aspect of it, and there are many different strategies. So my thought about there are many different strategies, right? But at the end of the day, you need to know what is it for you, right? It doesn't mean that everybody invests in, say, cryptocurrency, you should go to cryptocurrency. If people invest in blue-chip companies, dividend stocks, you should invest for dividend stocks. Okay, so you need to have a mind of your own if you really want to pick up investing. You need to eventually filter down. Of course, at the start, it might be very challenging, right? Because there are so many strategies out there. Which one should you do, right? You haven't even know or understand one strategy. How can you just dive into it? It's almost like asking you to marry someone without knowing the person. There are many people out there, right? So it's that same issue. And I think that the idea would be more like, I once met a a fellow trader and he shared with me, I thought it's quite a good analogy. So at first, it's almost like a buffet, right? So there can be many, many strategies out there, right? You don't know which works for you. So you just take a little bit, understand a little bit, try a little bit, and you see whether is it your cup of tea, right? So eventually, just like a buffet, you will find certain food that is more palatable to your appetite, to your taste buds, and that's where you really zoom in and become focus on those things, right? Just like you focus on that few strategies that are really tailored to your objective, investment objective, your risk tolerance, okay, and essentially your preferences. All right. So that's how an investor learn. Okay, it's an evolution process, and it's definitely going to take time. I'm not going to lie to you and say, oh, you just follow this strategy, you do this, and then next week you become a millionaire. That kind of get rich quick story. Okay, unfortunately, it is an evolution, right? It does take time, but it is definitely a skill set. If you spend enough time, you will be able to get better over time. Okay, so that is essentially the backdrop of the different strategies and what you should do. And sometimes, of course, people are always concerned about, we just not talk about crashes, right? It is one of the key concerns that people will have. And this is the characteristics of stock market. Okay, stock market deliver good gains, right? Big gains, but it also have stock market crashes. And there are, of course, different ways to deal with it. Okay, and that also depends on the strategy that you use. Some would just focus on the quality companies, and then even if they crash, it doesn't matter. They don't intend to sell anyway, right? So even if they go up, they won't sell. So it go down, why would sell? So there are strategies where you just focus on quality stocks and you just continue holding them. Okay, but of course that requires someone to take that drawdown. And there are some who say that, okay, based on certain technical indicators, this happened, we will get out, so we stay in cash, all right? Some even more aggressive one, they will short the market to try to make money when other people are losing money. Okay, so again, this is dependent on the kind of personality you have, the kind of risk tolerance you have, right? Because each method may require a different scale, okay, a different level of risk tolerance. So that is another characteristic of crash, which I think that the characteristic of stock market, which is the crash, and I think that a lot of people are very concerned about that. Okay, and because of this, then some people will look at the macro, okay, or the economy, basically, right, or the broad market condition, and they try to predict whether a market is going to crash. Right. So again, this is a view of mine, and I think that most people won't do well in terms of prediction. Okay. So because majority of time prediction is not going to be correct. Okay. And the market, especially at the macro level, is a lot more complicated than what people can comprehend. Okay. Even I can tell you the economists, the PhDs, even the Federal Reserve, they don't have 100% understanding of where the market is going, what the market is doing at any point in time, because it's just a mega system with so many moving parts and each affect one another. Okay, so it's just too complicated for our brains to really comprehend the whole economy. So with that incomplete understanding, right, how can one accurately predict market crashes? Okay, so usually it is difficult, right? But there are people who try to use certain system to try to be more reactive rather than predictive. Okay, so reactive, I can deal with that. Right, so that means something happened. There's a trigger, and then you take an action to say, I would want to be resolved. Right, so there is another way. But in terms of this macro kind of outlook, usually is very, very difficult for the beginners to start with. And this is something that I would not even recommend anyone to do, right? Especially a beginner. Of course, if you are someone who has been investing for a long time and you're quite well versed with economic terms, market terms, then I think it's fine, right? But if you are starting out from a beginner, I think this is the area to be avoided at first. Okay, stick to the investment strategy, right? Pick one that's suitable for you, and you learn how to execute the strategy in the first place. Don't try to jump the levels and do something difficult. It's just like if you are attending primary school, you are taking that primary school level subjects, you don't go and try to do a university subject. It's just not going to end up well. Right? It takes time to build a foundation. Okay, macro, it is important, right? Because the macro environment does affect the stock market. I think Wharton's the business school that's famous for their MBAs. So they talk about the market, right? The stock movement of an individual stock. The market is contribute about 50% of the stock movement. Then the next one is about the sector, which contribute about 30%. And then the individual stock only contribute to about 20% of the stock movement of an individual stock. Okay, stock movement. Right? These are the factors. Okay, so indeed market is important, right? But just that you have to start from the bottom. It's easier. More like, even if you learn, I don't know whether you learn economics in school, right? You always start with microeconomics before you move on to macroeconomics. Okay? Usually understanding a single component in the economic system is a lot easier than trying to understand the entire system right from the start. Okay, same thing. If you want to invest in stocks, you start with the individual stock first. Don't go and look at the market and sector and things like that. Right? Start from individual stock. If you can understand individual stock, then you understand how you link up to the sector, how you link up to the markets. Okay, so this is another aspect that I want to share with you guys. All right. So with regards to investing, now I'm open for questions. Okay, so if anything, especially if based on what I've talked about, you don't understand or you want more elaboration, feel free to ask. Come, the floor is yours. The chat box is open. You can just type your questions there. No question. Don't know what to ask. Some people believe in dividend investing. Okay. You can ask me about, of course, you can ask me macro questions. You can ask me about particular stock. You can ask me about financial statements, financial metrics, questions like this. Okay, Ray have a question. So one should look at theme to start into looking into potential stocks. That's a very good question, right? So maybe let me answer what Ray idea is, right? So Ray idea is like, oh, let's start with the sector first, then we zoom into the individual stocks. Okay. Potentially, this is an investment method that is more thematic in nature, but it is not an investment strategy by itself. Okay, so what do I mean by that? Right, you need to be very careful about this. Okay, so if I talk about themes, right, investment themes, okay, based on what Ray have mentioned, right, investment themes. What are the themes that you're thinking of? What are the themes that you're thinking of right now? Or Ray can even share what are the themes that you're thinking of? Okay. It's an interesting question. It's not wrong to think like that, but there might be a lot of danger that thing like that. Okay. Don't know what themes. AI. Yes, AI. Okay, so let's just use AI. Correct. So because AI is very hot right now, and a lot of people believe that AI is going to be the next technology frontier. Okay. So I definitely believe that AI has utility. Okay, that's the most important thing, right? And because when it has utility, then it's value. When it's value, then it can drive stock prices, right? Because if something has no value, eventually it cannot hold. Okay, it cannot hold a high stock price. So AI now is definitely one of the hottest. And then people think about, oh, so what are the AI stock? Well, favorite, of course, NVIDIA. Then people start to look at, oh, maybe, we talk about chip maker, TSMC. Then we talk about the designers, right? Or the big tech that involved, like Alphabet, like Microsoft, right? And then some may even be more peripheral, like Adobe also have incorporate AI in their Photoshop, right? To have AI generated images. Okay. Then some will think about how about other smaller AI stock like maybe Palantir, uh, what else? C3 AI, right? Some of these companies lah, basically, right? So that's like an idea of generating investment stocks ideas via a thematic approach, right? So it's more top down, correct? It's more top down. Okay. Nothing wrong with that, but there is usually a problem. Okay. Why? Let me ask you. Okay, so you think about AI, right? Do you think it is hot right now? Is it likely to be overvalued or undervalued, generally speaking? Do you think it's slightly overvalued or undervalued? Okay, we say slightly overvalued. I agree lah, right? Because on top of the utility, right, there's a layer of hype lah. Okay, so right now, right, the share price, right, of a lot of the AI stock, right, is okay, there is real potential plus hype price into it. And this is not what we want, right? Because hype pushes the share price higher than what it should be. Okay. So you want to buy the real potential is fine, but you don't want to pay another premium for the hype. Okay, so right now the AI is like that. So the problem with thematic investing, right? If you realize over the years, if you think in terms of themes, right, you will tend to always invest when a theme is hot. Fair enough. Agree? Okay. How many other themes you can think of? No, it's AI. Crypto, a few years ago, especially 2 years ago, 2117, correct? Very hot. A lot of people think that that's the future. You're going to replace money. What else? Return of travelers, right? To the post-COVID travel boom. Okay, what else? And other themes? EV? Yeah, right or not? Do you realize that a lot of times these themes come to the fore? It is a sign that it's near the top rather than near the bottom. Yeah, so ESG, all these kind of things, correct? Anything that is hot usually is hyped up already. Okay, so that's why I want to warn you about thinking in terms of themes, because that is where most people will end up buying what is popular and end up paying a higher price than they should. Okay, nothing wrong with thematic investing, right? As I said, you're supposed to, of course, drill down to the individual company, and you're supposed to do what? A valuation. And then you're also supposed to evaluate their future, right? Whether it is true or not. Yeah, NVIDIA now is the king of GPU graphics card. Okay, but you have to think about this confirming evidence, right? What would make NVIDIA obsolete in the future? Right? If you can find something that, or find many things that NVIDIA can be obsolete in the future, right? Then maybe this is not a steady bet on AI, right? You might want to think about other stocks, right? So these are the considerations. So which means that we should not just blindly or based on whatever theme that we think of is hot, and then we jump into the individual stock. Okay, so that is what I want to advise against actually. Yeah, let me see some of the questions. Questions are coming in. For ETF, what should we be looking at if looking at 5 to 10 years? Okay, good question. Right, so some will say that I don't want to pick stocks, very headache. I just want to buy an ETF. Okay, so if you want to buy and hold ETF, right, of course, there are also thematic ETF, but I think thematic ETF is usually not suitable for long-term investing because they ride a wave and then they're gone. Okay, so if you don't know how to sell them, it's going to be very problematic. So let's say you want to buy ETF and you want to hold over a long-term period, 5 to 10 years. All right. Remember just now I talked about the macro is important. Okay. So when you buy ETF, right, you are actually buying the entire market. You don't care about the sector individual, correct? You're buying the entire market. So when you buy the entire market, right, there are some consideration. Okay. For long term, right, try to get a broad market index. Okay. So you ask me what is a broad market index, right? Maybe I give you an example. Okay, S&P 500 versus semiconductor ETF. Okay, which is broad? Which is broad? Which is broad? S&P 500, right? Okay. How about S&P 500 versus QQQ? Still S&P 500, right? Because QQ is very focused on tech. And this is 11 or 12 sectors. Okay. And some people say, oh, but S&P 500 very US centric. Okay. Yes and no, right? Yes, the companies are based in US, but the business that they are in are actually global, right? Because America have a lot of MNCs around the world. They don't just earn money from Americans, they earn money from all over the world. So it is still considered broad. If you want to go broader, then you can go for like in international or world indices like VT total market, Vanguard total market, ETF, something along the line that invests all around the world, or AWCI, right? That invests around the world as well. Okay, so basically a broad market index, passive, not those active investing where the fund managers make a decision. So we just follow the index. Okay, so must be passive. Of course, low cost as much as possible. Right? What is low cost? I would say 0.2%. Okay, because if you want to hold longer, you want to keep the cost lower as much as possible as well. Of course, they should be bigger, they should be broader, they should be more well known in that sense. Okay. All right. Okay. Related question. I'll try to answer together. Is MSCI China and HS Tech index worth dollar cost averaging now and then who out? Right. So this is related to the ETF question, right? Okay. The question, right, Melissa, you should not ask me. You ask yourself. The reason why I say that is because you need to have even when you buy an ETF, right, or let's say S&P 500, you need to have the conviction. You need to believe in it. So your plan is to invest 5 to 10 years, right? When you choose to select S&P 500 as your investment choice, right? Then even when S&P 500 crash, right, you're supposed to have the conviction to see through it. Okay, so same thing for MSCI China or HS Tech is the same. Right, so again, I would say MSCI China is the better index than HS Tech because MSCI China is broader. It doesn't just include the tech. Okay, so the idea is the same. You need to have enough conviction. If you waver, right, means you don't understand enough and you have not developed enough conviction to invest in that counter. Right? It's as simple as that. Okay, but that said, it is important that when we talk about the macro, right, since the market is one of the crucial driver of stock performance, choosing the right market is important. Okay, and of course, when we look at a country, right, we want it to be able to what? When you invest in the index, right, ETF, right, usually is based off a country index, correct? And if you choose a particular country, right, what is one of the key things that you want to look out for? What makes you choose a country? What makes you choose China? What makes you choose US? What makes you choose Singapore? What makes you choose, I don't know, what other countries? Okay. What is the principal consideration? You know? Do we say political? Okay. What else? What would make your ETF price go up? What would make your ETF price go up? That's the key thing, right? Because that's how you make money, right? The ETF price must go up, right? Over the long term, right? What will cause the ETF price to go up in long term? Yeah, it's the long-term economic growth. Okay, which means it's the GDP growth. So in order for you to pick, say, China, right, you must believe that their GDP will continue to grow for the next 5 to 10 years. Okay, if you pick US, you're supposed to believe that the GDP will grow in the 5 to 10 years, because if the GDP grow, it's a function of the individual companies in the economy that grow, right? Because the company generate more revenue, so the overall GDP grows. And because the company generate more more revenue, their value has gone up. And so the share price reflect the increase in value. Okay? So if you don't believe a country GDP has a potential to grow, right, you should never buy the ETF, because it's not going to work out. Okay? And the next thing is that, yes, your GDP can grow, right? Does it mean that the stock market will always go in tandem with the GDP? No, right? Sometimes it can crash, right? Correct or not? And that's where your conviction must come in. Okay? So that is how I look at the ETF. It sounds simple, but until the ETF have a major correction or crash, that's what spook people, right? Remember I talked about the crash is usually what causes people not to think straight. Okay? Because it's scary. Right? It triggers our survival instinct, fight or flight response. Okay, but if you focus on the right area, it's actually simple. Okay, don't need to think about it, right? Yes, my conviction is shaken. How do I stay calm? As that's what an investor need to do. Focus on the right thing also. That's why I say go back to basic. Do you believe that China GDP growth will continue for the next 5 to 10 years? Okay, so if you believe, then stick to your plan. Okay, all right. Can Let me answer other questions. Let me see. Is it a good idea to invest REITs over a long term? Okay, so next question is about real estate investment trust, which is a very popular instrument because it pays good dividends, right? Okay. Is it good for long-term investment? Of course, if you love the dividends, okay, and if you love real estate, if you understand real estate well, okay. The next question I want to ask, right? Okay, so definitely it's suitable for long-term investment, okay, because you get a good flow of dividends. The next question I want to ask, right? Do you think any REIT is good for long-term investment? Oh, no, right? Not all REITs, right? Just like not all stocks are worth investing for the long term. In fact, majority of the stocks are not good for long-term investments. ETFs, you can get away with it because the ETF, the index, has a self-selection system, which means if a company cannot make it or bankrupt or what, get kicked out of the index, it will be replaced with a new stock. So there is a rejuvenation to keep the index going. But your own portfolio, right, is a different thing. If you don't sell the stock, right, the lousy stock will still be in the portfolio. Okay? Right, so for index, it's a lot simpler. You don't need to care about how the individual company perform. But when you start to pick the stocks or the REITs, right, you need to make the decision because you make error and every investor will make error. And you need to clean out your portfolio. My observation is that most people don't clean out portfolio. They just let the stock rot there because it's very painful to sell at a loss. Correct or not? But sometimes you need to be discerning, right? When especially there's a permanent damage to the REIT. Okay, I don't know how many of you are familiar with it, right? Like the most recent big case will be Manulife US REIT. Anyone follow? Anyone? No one knows about it. Bother about it. Yeah, it stopped paying dividends. Okay. That one overgeared already. Why overgeared? Because the commercial property in US is crashing. All right. And some people will think that, wow, but it's a US REIT there. Okay, then people will say China REIT, maybe understandable, but US REIT there can go from what, 80 cents to now below 10 cents and stop paying dividends. Okay, so not all REITs are worth holding long term. In fact, I can say that majority of the REITs, there are more than 40 REITs in SGX. I would say majority of them are not worth investing in. Okay, so I guess the other common problem that people think is this: as long as I hold the stock long enough, I will make money. Is this sentence true? Is this sentence true? As long as I hold long enough, because they say, well, stock always go up, one. Yeah, it's the index usually go up. Okay, not all stocks go up. This is a very deadly mistake. Okay, that a lot of people have a wrong mindset. Okay, that's why I say that index is fine as long as you pick the one with the GDP growth for long term, the price should follow. Right, it's fine because the index have a survival of the fittest phenomenon. Right, you will kick out stocks and can replace. They will only hold the strong stocks at any one point in time. But when you buy your own stock, it doesn't mean that you just hold every stock that you pick, right? You will all go up as long as you hold 10, 20 years. It's not true. The majority of them are not worth holding for long term, which means that you need to be very careful when you select a stock, right? There are like, I give you some statistics, right? There are like 5,000 stocks in the US. There's like, even in Singapore, you have like 700 stocks. Okay, and in China plus Hong Kong, maybe about 7,500 stocks. There's more than 10,000 stocks out there for people to pick. And how many stocks are you going to put in your portfolio? Maybe 20, 30? Correct. So you have the ability to be more stringent with your selection. Correct. You don't need to be, wow, anything a little bit, just buy, right? So it pays to be a bit more careful. It pays to be a bit more stringent. Okay, to improve your selection. All right, can. So that is some of the, I also hope to share some important mindset that you should have when it comes to investing. Okay, just remember, another way, right, is that y'all can take a walk at the museum, National Museum. So a few days ago, I just went for a visit, right? So I just and see the history of Singapore, right? And I realized that, wow, there are a lot of companies that I never heard of before. Okay, why? Because they all died already. Okay, so people don't realize that how many companies actually die or get acquired, all sorts of reasons. They just cease to exist anymore. Okay, there are actually plenty of them. So given enough time, right, some companies will die on. Okay, so you need to be stringent with your selection. That's why what I'm trying to emphasize. Okay, don't just based on your gut. Oh, I think this stock can make it. Okay, you need to be really objective and really understand how the business is doing and be ruthless. If you're wrong, you need to sell before it's too late. Yeah. Let me see. Ray Tan asks, so does Manulife Aka commercial office REITs in US return back to its fair value after some years? I mean, some of the office properties, I don't think they will return back to their original price or their original value. Okay, you know why I say that, right? After COVID, right, the demand for office property, right, has permanently changed already. Okay, it is not a temporary thing, right? Because after the Americans experience work from home, right? We don't talk about Asians. Asians, the problem is not as big as the Americans. In the first place, the Americans, right? They like to live in a city fringe. Okay, they don't like to live in a city one. Right? The people who live in the city are the poorer people. Unless you live in a penthouse, then that's a different story. But the apartments, all those, right? They are usually not so well to do one. They prefer to live in those single family homes, those detached houses, all by themselves one, right? So they don't mind driving to the city for work. But after COVID, they realized that why should I even drive to work? Okay, so they just buy the house and then stay there. And that's also one reason why Warren Buffett buy a lot of home builder stock last quarter, right? Because the home builders are booming. A lot of people buy house and build house, right? They realize that I don't need to go office anymore. I can live further now. Let's build bigger, build nicer. Okay, so which means the demand for office is permanently reduced. And that means that there is excess capacity of office units out there. And they need, I don't know how many years to clear the excess capacity. Some are converting to residential, right? I don't know how you unfold, but what I know is that because of this permanent change, right? If let's say before COVID, they are worth $100 million. After COVID, it's not going to worth $100 million. Even if the price go back, right? Maybe, I don't know, a fraction of it, 60 million, 70 million. Okay, this is what my view is lah. Okay, so that is why when you invest, it's important to know what is a temporary problem and what is a permanent problem. If it's a temporary problem, it's okay to hold because the problem will go away and your investment value will go back up. But if it's a permanent problem, right, it will not go away. It will stay there, and you're just hoping for the best. And hope is not a good strategy, right? Because investment, you can't do anything about it. You can't go to the property and like convert it and try to increase the rent. Right? You are just a person riding on that REIT manager to do the work for you. But sometimes it's not that REIT manager is not good. It's just the market condition has changed dramatically that is beyond what one person can do. And that is what is happening in the US commercial real estate market. Okay. Right. So if you have Manulife REIT, it's a difficult problem. Okay. We've been writing it since like many months ago. Of course, the if you ask me if I have it, I will sell it and move on. Okay, at least you can salvage right? Otherwise, my guess is that Manulife US REIT will eventually get suspended from trading. Okay, that's my guess right? I'm just giving my view. It's not confirmed that it will. Okay, don't get me wrong. I'm just saying that the chances are likely, you see, because of it's very difficult to get out of the problem right now. They cannot stop. They have to stop giving dividends. Okay, and the price will plunge because a lot of people will get out. All right. KBS Pack Oat REIT, is it in the same boat as Manulife REIT? Similar situation, same but different. Right. The saving grace is that this Pack Oat REIT, right? They serve the tech sector, and their office is not grade A kind of spanky office. They are more for like closer to tech centers. Okay, so their problem is not as bad as Manulife REIT or Prime US REIT. Okay, but they suffer from the same whack by all the investors. They just want to get out, risk-off mentality. Okay. Capital Land Ascendas REIT, also office REIT. No, Capital Ascendas, no. Capital Ascendas is industrial. But they probably got a bit of business park. Okay. Yeah, that one is generally Asia is still okay. But I will also be careful about Asian office REITs. If you take a look at even Capital Land, Integrated Commercial Trust, right? Prior to that, they were split into office and malls, right? The office has always been a weaker one. You look at Suntec, look at Keppel REIT, even though their office is in Asia, they haven't been growing for like, I don't know, more than 5 years. Stagnant already. Okay, so, and with this post-COVID thing, right, there's very little upside to talk about. Okay. United Hampshire, in my view, is still okay, right? Because they are dealing with retail. The biggest problem is how e-commerce will change retail. Okay? Because Americans are a bit different as well from Singaporeans who go to retail and shopping, right? In Singapore, the malls are very close to us. It's very convenient to go to the malls. For the Americans to drive to the mall, maybe a 1 hour drive. That would, then they think, hey, now Amazon can same day delivery, why would I go to the mall? Okay, so there may be a structural change that's going on. Right, but right now, I saw the latest result. They're still okay. Occupancy, all these are still okay. Right, so United Hampshire is not as impacted as the office REITs in the US. Okay, yeah, I think malls in Singapore generally are okay. Okay. Cromwell is Europe, right? Europe, I'm not so familiar. Yeah, I don't know what's going on right there. I don't know how much of the change of work from home is, but that is an area that you want to watch out for. I think Cromwell is office, right? Any office REIT around the world, you need to be careful, generally. Okay. Yeah, that's why I say not all REITs are worth investing for long-term one, because you give it enough time, right? A major problem will crop up, and then you will derail everything, one. Yeah. So you have to be very careful what you pick. Yeah, Fraser Center Point, I think it's okay. Local malls in Singapore always do well. You know why? Because there's nothing to do. And also that every day there's a lot of commuters, right? It's part of the journey. Malls are always strategically located, part of the journey of locals. So it's fine. Yeah. Okay, let me answer. I know Reed's got a lot of interest, but let me answer other question first. Okay, we can always circle back. Some question. Should we look at individual stock we have interest in or can relate to? That's also a very interesting question. Okay, so because Warren Buffett said, right, you need to have a circle of competence, right? Okay, and Peter Lynch said that, buy companies you buy things from or buy the services from. Okay, so that's another idea lah. I definitely encourage investors to look at what you are familiar with. And generally, I always also think that B2C company is easier than B2B company. Okay? Because B2C company is like we are all consumers, right? We all buy stuff, we all compare products and services. So we roughly know, what are some of the products that sell well, what are some of the services that are well demanded. It's easier to understand. B2B, a bit hard unless you're in the industry, right? Like even some people talk about semiconductor. Yeah, I know lah, chip very important, very, very key thing lah. But do you know who has the power? Do you know how even the commercial deals are being struck? Okay, what is the value chain like? Who are the suppliers? Who are the competitors? And who do they sell to? Right. So usually B2B is a lot harder, okay, to understand unless you are in the industry. Okay, but that doesn't mean that you totally cannot learn about them. You can. Okay, just that it's harder and it's always easier to start from the B2C side. And so that's where I would always encourage people to look at, right? Because you already have some background to begin with and not start from zero. And this is usually from the qualitative analysis. Okay, so when it comes to investing, right, there's also two parts that you need to take note of. One is more quantitative, one is more qualitative. Okay, a lot of people prefer the qualitative. Okay, because it always feel easier, right? Oh, I understand the business. Maybe we give an example, right? Like DBS. Okay, I use their service. They're B2C company. They also B2B actually. But yeah, it's the biggest bank. People think like that. Biggest bank, Temasek Bank. Okay, so won't die good. Okay, do you think this is enough to make an investment decision? But a lot of people think like that, right? Jan say yes. Yeah, just buy the biggest bank. Temasek Bank won't die one. Yeah, just like SIA won't die one. Okay. Okay, let me flip the question. Let me flip the question back to you, right? Are there Temasek Bank companies that have not been doing well? They have not done well. Have or not? Which one? Which one? NOL. SVH. What is TIH? SPH, I don't think SPH is Temasek owned. Okay, SPH is not. SATS or Transpec. Or Transpec. Transpec died, I don't know where already. Transpec is Temasek, man? I don't know. NOL SATS. How about Singtel? Singtel doing well? Singtel doing well? How about what's the new company? Citrium? How? Citrium doing well? Right? So is it good enough? Or oh, Temasek bag sure can buy one. Akong stock sure can buy one. Not true, right? Okay. Sometimes it's really industrial headwinds. Okay. So what must you do then? You must assess yourself, right? What's the business segment they are in? Where's the growth going to come from? If there's no growth, can they continue to have the stability to give the dividends? Correct? Okay. And quantitative is that what's the valuation? What's their financial metrics? Valuation is one. The other part is that the quality. You can also use numbers to determine quality, like what's their margins like, okay, what's their ROE, ROA like, right? Is the management delivering that business quality there? Some of these things. Okay, so then the analysis will be more complete. Right? I know usually this is not easy because you do need to have some knowledge to do all this kind of evaluation. Otherwise, it can be a challenge. But that is precisely something that you should know before you invest in individual stock. Right? It does take effort, okay, in order to know. And also because you understand the business better, okay, then you will have more conviction when the stock suddenly meet issue, right? Like I ask you, if you know DBS, right, very well, right? Okay, then I ask you, right? So if let's say now people talk about digital banking, right? Or your GXS, your trust bank also coming in. Do you think this digital bank will pose a threat to DBS? Right. So these are the things that you need to consider, right? Because the landscape has changed, right? How? How? Just using it as example. Okay. Is it a threat? No threat. Got threat. Oh. How? Not this generation, maybe next generation. Okay, potentially, right? But if you ask me, it's not a threat at this point in time, definitely. Right? The market share is just too big already. It's too entrenched. And even digital bank, they're limited by the amount of deposit they can take in. And DBS is not like very backward, right? They also had their iBanking app for so long already. A lot of digital payments are also can be done there. It's not like the new digital bank is so special. And it is not the first time that the local banks have faced challenges. Right? If you recall, in 2000 or 2001, that period, Singapore opened up the banking system to the world, and you have companies like JPM, JP Morgan, Citibank coming in to fight a pie with the local banks. And end up they survived. In fact, they became stronger. Correct? Like Citibank has been around for so long. Did they take market share from DBS? Citibank big or not? Big name or not? Big. Right? But didn't take away. Okay, so a bit hard, right, for the digital bank to come in to just take a share of it. Okay. Yeah, they already have all this app, right? And also, you think about this, let me ask you, let's say you want to open a CPF IS account, use your CPF to invest. Can you open with GXS? Cannot. Cannot. Can you open with GXS? No? Cannot, right? Your CDB account, can you open with Trust Bank? Cannot. Your baby bonus, can you use Citibank? Cannot. You realize the problem? SRS, investment account, cannot. Cannot. You have to go to three local banks. Can you see? Even the government use them. You will not move away one. Right? So these are the analysis that you need to do, right? Not just because of the Temasek back then. Okay, so this is ultimately how does it force a customer to choose a particular brand or service or product? Then this is how do you value DBS? correct? Which is the quantitative part. How do you know what is the fair price for DPS? So many metrics out there. Should I look at the P ratio? Should I look at the PB ratio? Should I do a discounted cash flow? Should I compare among the banks? Oh, okay. Then of course valuation also have different methods. Okay, let me explain first. Then I'll probably use this example to share with you how to look at this. Okay. Oh no, my pen is not working suddenly. Okay, pen is back. So for banks, right? You have to understand that there are definitely a few things that people can look at. Okay, I'll just share with you some of my way of thinking, okay, to make it simpler for you, right? So that means there's like income statement. So I need to go a little bit about statements. Maybe I can pull out the statements. Yes, okay. So there are 3 general financial statements for every company. And you have to know at least how to interpret them. You don't need to know how to prepare the financial statements. You don't need an accounting degree, okay? But you need to know how to read them. DBS will have their 3 statements, OCBC has 3 statements, any company will have their 3 statements. And it's important to know what are the key things to look out for. Okay, so this is part of learning that everybody has to go through. And for example, some of the well-known metrics that people are looking at, if you learn about PE ratio, right? Where did the E come from? E comes from here. Okay, so we talk about PS ratio. So is your sales. The S comes from the revenue. So they both come from the income statement. Then there's also like P over free cash flow or any cash flow metric, right? That comes from the cash flow statement. Okay, right? Then there's also price to book ratio that comes from the balance sheet. So one way is that you can use a composite of metrics so that you take items from each financial statement to make sure that you get a more balanced view about the company's valuation. Okay, I'm not a fan of discounted cash flow, right, which is projecting the future profits. Banks, especially DCF, may not be suitable, especially if, let's say, their revenue or earnings, right, is impacted by interest rate movement as well as economic cycle. So which means banks are actually cyclical company, right? They go up, boom and bust. Okay, so if they're boom and bust, usually it's very hard to predict what their future cash flow is going to be like. So I prefer to use financial ratios like this. Okay, and I'll usually prefer to use a composite of them because that gives me a better overview about where they are. And you can also add in a dividend yield. Okay, to see if, especially a dividend investor, the yield is important, right? Otherwise, try to get a more balanced view. And in terms of for banks, the other way to interpret it is that, like what Ray has said, right? Use price to book. Why use price to book? Okay, because if you look at the rest of the metric, right, we say that it's very it tends to be cyclical, right? Banks. Okay, so when the banks are at a peak, your sales will be high, your earnings will be high. Okay, when the cycle is at the bottom, then the revenue will be low and the earnings will be low. Okay, so which means that PS and the PE may fluctuate a lot as well. So they're not very stable. Same as the cash flow, they'll fluctuate a lot. Okay, they may not be very stable for you to analyze, especially to compare historically, right? And especially for banks, their assets are quite valuable, right? Because it's the depositors' money, the loan book, which they use to lend out and collect higher interest as compared to the payout to the depositors, right? So their asset base is very important. That's how they make money. Okay, is via of other people's money, which is captured under assets. And we have to, of course, be more stringent, right? You minus liability, then you get the equity, then you use the price to book ratio. So the price to book ratio is definitely more stable compared to other metrics. So that's why the price to book metrics will be relevant to analyze banks. Hope you understand what I'm trying to talk about. Okay, so it's logic. Okay, it's not like, oh, I just use P ratio because I know P ratio. I don't know the rest. Okay, it has to be relevant for that kind of company, for the kind of business, then you will get that more concrete signal whether this is going to be a good buy or not, right? So you realize that if we can revisit before I talk about the how do we then look at the DBS valuation, right? You realize that we have been talking about quite a lot of things, right? To look at, it's not just because it's the biggest bank and domestic bank. Okay, there's quite a lot of things that we can look at. And after you have run through all these things, right, that's what people call due diligence, right? And once you have done the work, right, then you realize that, yes, finally, I understand this company better than before I done my work. And that is where that confidence and the conviction will come. Okay? And if DBS share price go down, but it is maybe it's because Singapore economic growth has slowed down, right? Then you will not panic because you know that economic growth eventually will come back, right? It's not a DBS problem. It's just a down cycle for all the stocks. Okay, so then you have the confidence to hope. All right, so that is why I emphasize that you need to know what to look out for, and that takes time to learn. Okay, and now let's then look at some of the tools, right? Then you know what tools to use, right? So let's say, oh, so I know now I need to use price to book. But then the next question is, let's say I don't know what's the price to book now. Let's say DBS price to book 1.3 times. Is it cheap or expensive? Then you get the number, you see the number. Then you stare at the number stare back at you. How? Can buy or not? How do you know? How do you know? Compare with peers? Okay, then maybe okay, good. Okay, compare with peers. DBS 1.3 times, then OCBC 1 time, then UOB 1.1 time. Which one you buy? Which one you buy? Which one you buy? OCBC, OCBC, OCBC. Confirm? Because it's the cheapest. Okay, Ben say compare against 5-year average. Wei Long say historical 5 to 10-year PB average. Good. Okay. Yeah, I'm going to show you. Let's all learn together. Just give me a while. Just give me a while. Let me get this up. Okay. Okay, let me get this up. You can see, right? So I choose PB ratio, this DBS. I choose 5 years average, 5 years range. And I choose the standard deviation. Okay, so let me verbalize for you. Maybe it's too small for you to see. The average PB ratio is 1.33 times over the past 5 years for DBS. Okay, current price to book ratio is 1.5 actually, 1.47. So is it expensive or cheap? Can buy or not? Expensive, right? Okay, so it's not a time to buy. Then you know, right? So maybe you done your qualitative analysis. Okay, I think it's a good company, but then I don't know whether is it, but now it's not the right price. Then you just watch this and wait, wait until when the price book is 1.3 times, or I would say that maybe 1.3 times is still expensive, 1.15 times. Okay, is a price, is a price book ratio to go in. All right. Then we look at OCBC. Then look at OCBC, right? Average is at 1 times. Okay. And now the price to book is at 1 time also. Fairer, right? Okay, it's a fair price, but probably wait until 0.92 to be more gassy. Or kiasu. Okay, same thing. Then you check for UOB. Okay, so the average is about 1.1 times for past 5 years. Okay, now it's about 1.2 times. So it's about fair. It's not undervalued. It's fair. Only DBS is overvalued. The OCBC and UOBs are fair. Okay, so that's how you make an analysis. Then you know that, okay, so what should I do? Wait lah. Okay, don't need to always buy, right? Yeah. Why 5 year, not 1 year? Because 1 year too short lah. 1 year, you only got one book value only. Okay, you need to stretch longer, especially you want enough market cycle, right? Okay. And the other thing, just now, some of you suggest comparison, right? Well, it's essentially, right? Okay, if you remember the average 5 year PB, right? For DBS was 1.33. Okay, 1.3 lah. OCBC was 1, UOB is 1.1, right? Exactly these numbers. Okay. So if you say that you compare these three banks and you believe that OCBC is cheaper, right? So you buy OCBC, right? It is not a right conclusion because OCBC have always traded around price to book 1 times. So instead of doing a comparison, you should check against their own historical range. OCBC is not undervalued, even at 1 times right now, because this is the normal trading range. And that also tells you that DBS is trading at a premium compared to the other two banks all the time. Understand? Okay. So investing does require some of this analysis so that you can make a more informed decision. It's not just compare, oh, this is the lowest I buy, right? Because why? Then the next question is asked, why does DBS trade at a premium compared to the other two banks? Right? It's a valid question, right? Why? Why DBS deserve the premium? Why is it more expensive? Why LV bag is more expensive than Kate Spade? Why? Why? Why DBS is worth more than the other two banks? Branding and visionary CEO. Then the CEO change how? Then the premium will go away. Then cannot. Yeah. So basically, nobody actually knows right? Why there's a premium, but we can guess, right? So some of you get it. Some of you valid question, valid answers. Branding, yes. Market share. Usually, if a company have a dominating market share, the biggest market share, they are worth more. All right, the market leader is worth more. Okay, there's a premium to it. Doreen say government backing, yes, potentially there is, right? Because people feel safer, so they don't mind paying a premium. Yeah, so these are some of the potential reasons. But the more common thing I see is they are market leader. Okay? Investors are willing to pay a premium for market leaders. And the premium, most of the time, is worth it. Right? You want to buy the leader. Okay, don't buy the smaller competitors. Usually over time, smaller competitors find it harder to survive or prosper. Yeah. Okay, let me see. What other questions? What other question? With local banks, net interest margin appear to have peaked. Are the current prices still okay? So we answered that already. How do I find undervalued SGS stocks that can pay dividends with buy and hold strategy as I don't want to monitor day and night? Okay, this is a question, right? The short answer is that you don't need to monitor day and night, but you still need to manage the portfolio. Manage the portfolio means that you need to sell some stocks and replace them. You cannot totally go away with it, right? It's not like a lot of people, the idea is like, oh, I decided these 20 stocks, I've done my work, these 20 stocks, I'm going to hold until I die. I buy them now and hold until I die, no matter what happens. Okay? It doesn't work like that. Right? It's okay if you bought an ETF, right? Because ETF, as I said, it will self-manage. But when you buy your own individual stock, right, you cannot self-manage that one. You have to manage it. You are the fund manager. Nobody else is going to manage it. Otherwise, you pay a fee for other people to manage for you. Because some stocks will eventually prove as an error. Even if you pick 20 stocks, you won't be correct 100%, right? Maybe you are right 60%, 40% of stocks didn't make it, and you need to switch them out. Okay? There are methods that are less taxing, but you cannot go away not managing your portfolio and you just buy and hold without monitoring. Okay? That is not advisable. Yeah. Let me see. Okay, I see bank shares already. The one address already. So pretty common. What about ST Engineering? Overvalued? I think based on the last time I checked, which was probably yesterday, I think it's overvalued. Yeah. Jimmy asks, where are we at the economic cycle now? More fuzzy now. Okay. Macroeconomic question. I see I run out of blank spaces. How do I erase everything? I erase this one. Okay. Where are we at the economic cycle now? Okay, let's answer a bit macro question. Economy. Okay. What do y'all think? Let me ask you all first. Is the economy good? Do you see the outlook as good or bad? Survey. Ray say bad. Bad. James say slightly good. Sandra say bad. Melissa say bad. Okay, so most of you say bad. Okay, let's take it as bad. Next, how about market? Financial market, stock market specifically. Good or bad? What's your outlook? Going forward, US good, China bad, US good. Up but pull back now. Doreen say China good. Because you like down market, buy cheaper. Singapore bad. Okay. Some also don't know how to put already. Okay, so most of you think US good lah. Asia bad lah. Okay, general consensus. Correct? Okay. Then the next question I ask you, right? Does bad economy lead to bad stock market? Does bad economy lead to bad stock market? Melissa say yes. YK say no. Ray say no. Steven say yes. Jen say no. Karen say no. Marcus say no. Okay, most of you say no, right? Okay, good. Yeah, so now let me give you a review, right? So then we also take an opportunity to look at the investment at a macro level. Okay, so now we move on to macro area. Just now we were at micro level at the individual company. So at the macro level, it is true. The economy, a bad economy doesn't mean a bad stock market. Usually a bad economy signal a bottoming of the stock market. Especially when there's a recession announced, thereafter the stock market tends to do well. Okay, basically there's no correlation historically between the economy and stock market. Yeah, this is what most people find it very difficult to understand. And like I say, it's because the company earnings are good because even with the bad economy. It's not really true. Majority of the company, even the US now, their earnings has been poorer compared to last year, generally speaking. Okay, just that the expectation was lower. They managed to beat the expectation, but it doesn't mean that their results are better than last year. Okay, it's not really true, right? So economy does impact the company's revenue profits, but somehow the stock market can still perform well. Okay, the reason is very simple, right? Usually the stock market is a forward-looking mechanism, which means that before the economy slow down, right, the stock market already sell off already. So the stock market actually move first, then the economy follows. So for example, last year, US already sell down already, if you recall, right? If anyone was involved in the US market last year, you know that there was a major sell-off. Okay. Then this year, you start to see the economy slow down. Then this year, the stock market went out already. Can you see? So if you wait until the economy is good, then invest in the stock market, right? It's too late. The market already run already. That's why people say bad news is good news. Good news is bad news. Right? So this year at the start, people still talking about, wow, interest rate so high, don't put in the stock market, fixed D rate so good, bonds so good, right? Why want to take risk? Then end up the market chong and chong and chong and chong. Took a lot of people by surprise. Okay, so that's what the relationship between the stock market and economy. Basically, there's no correlation, but the relationship is there. It's just that the stock market is forward-looking. It happens first. So which means that you look at the economy indicator, you always be too late. Okay. Another thing is that how do you, inflation is a economic indicator, right? Let me ask you, right? So now we are in August, right? Okay, we're in August, right? Then we'll have the July CPI numbers, which is the inflation number, right? When will we know the August CPI numbers? When will we know the August CPI numbers? When will we know the August job report? September, right? Correct or not? Okay, can you see it's backward looking? Can you see it's a lagging indicator? All economic indicators are lagging. That means already happened already, then you report. The stock market not like that one. You will move before you report. Then you report already, they decide whether they have compensate enough or not. Not compensate enough, I go down some more. Correct? If I compensate enough, then maybe I overcompensate, I rebound a bit. Okay, so the stock market will always move first one. Okay? So let's go back to CPI, right? To know whether the inflation is coming back, right? You don't look at the CPI. What do you look at? What do you look at? What is a advanced indicator? Raise a PPI. PPI, all these are all lagging. All economic indicators are lagging. Yes, market is correct. It's commodity market. You look at whether your oil and gas price is going up. You look at your wheat prices, your corn prices, your gold prices, metals, everything. Because all these are the starting point of production, right? So if the raw material price go up, right, you will be sure that the producer will pass on the cost to the consumer, and that's where the prices will go up. And the commodity prices will have been moving already before the CPI. Case in point, last year during June, a lot of commodity prices started to come down. And CPI in June last year reported peak inflation rate is 9.2%. But commodity already crashed already in June when the economic indicator inflation say highest ever since 40 years ago. Right? Then what happened after that? July went down, August went down, just all the way go down until this year. Okay? Commodities already tell you the inflation is going to come down already. Okay, so remember this, right? The earliest indicator is the markets. Okay, and people still want to be before the market. They want to predict the market because they want to be in front of the market. Very hard lah. The market is as close as you can as a forward-looking mechanism. Okay. They say which few commodities should one look for? Definitely all the important ones are oil, gas, wheat, corn. You can look at steel, iron. This will be related to construction. Right? Any raw material that can impact a particular industry. Okay, interestingly. Okay. You all know Wilma, right? Okay, you all know Wilma, right? And Wilma has carry, Yihai carry Arowana. You all know, heard of this company? There's a subsidiary. This is listed in China. They make the Arowana brand of cooking oil in China. It's the number one cooking oil in China. Don't know. Okay, never mind. Okay, so they reported. So one of my investing friend asked me, how come their profit dropped minus 45%? How come? Okay, because considering that this is a consumer staple, the revenue is about the same. The revenue didn't drop, but the profit dropped 45%. And I say, quite logical. Why logical? Right? You think about this, okay? So the cooking oil, right? Especially Wilma, what do they do? What do you do? What do you think the cooking oil is made of? Palm oil, right? So what do? You check the palm oil prices, right? And for the last 1 year, the palm oil prices have been higher than, say, previous year, right? So the palm oil prices went up. So their cost of production went up, right? So which means their revenue stayed the same, but the cost went up. That's why their profit went down. Okay, same thing for the WH Group, which is the pork company in China. Same thing, they also report about minus 40%. Then you know what is the input? Is of course one is the feed, animal feed. The animal feed prices also went up. Okay, fertilizer is also another key thing that will give rise to the cost of all your agricultural product. Okay, so to answer what kind of commodity you look at, it depends on also the company that you look at. They will have impact. The prices go up for commodities, right? It's good for the upstream players. Prices high is good for upstream players. Prices high is bad for downstream players. Because their input for Yihai carry or Arowana, right, is palm oil. So they need to pay Wilma the cost price, and the cost price went up. So Yihai carry Arowana cost went up, but Wilma captured the profits because they are upstream. Okay? Get the picture. Right? Gold usually have very little industrial use. Yeah. So it doesn't really translate to a lot of all these companies at the end of the day, except for gold miners. That's the most direct relationship. Okay. Gold, you should just see it as if you buy gold, right, you're actually betting against the US dollar. It's as simple as that. Okay. Yeah. Maybe I will just extend a little bit on this macro side. Let me just erase this. Okay. Right. You must also understand that the other thing about investing globally, we have the US side, right? Then we have China, and we have Singapore. Few people talk about Europe, right? Although some people invest in, or maybe Japan, those are less of. Usually people focus on the bigger countries and their home countries, right? So Singapore is where we be. Okay. The country does influence how you think about investing. okay, or the kind of stocks you actually buy at the end of the day. So when you come to talk about valuation, right? Okay, let me ask you, right? For the same fundamental analysis, for the same kind of business, okay, let's say there's one in US, there's one in China, there's one in Singapore, right? Same business, same fundamentals, exactly the same. Okay, assuming there's one such company or three companies to compare, they're just different location. Which company, where they're based in, will tend to achieve a higher valuation than the others? US, okay, correct. All right. So let's say same company, same business. Sorry, different company, same business, same fundamentals. In the US, maybe this company will be trading at PE 25 times. In China, maybe it will trade at PE 15 times. In Singapore, maybe it will trade at PE 10 times. Okay. Why is there a difference in the valuation? What do you think? Market volume, growth forecast, it's the same fundamentals. Okay, let's assume that they are exactly the same with the same growth prospect, everything. Okay, it's probably got to do a little bit about market depth, market volume. Okay, you have to understand that most of the money, right, investment money, is coming from the US. It's the richest country in the world, no doubt about it. And which means they control the fund flow. Right? A lot of the biggest hedge funds, the biggest mutual funds are all based in US, including the ETFs. So they control a lot of the fund flows. Right? Like for example, you invest in S&P 500 in the US, your money flows to the US, right? Then the US decide where to invest money. Can see they are a magnet for investors' money. Okay? And most of the time, of course, they invest back in the US. Right? So there's more demand chasing the stock and pushes the share price up. Right? Then sometimes they like China, they buy China. Now they don't like China, so they exit China. Can see? Okay. So the world is at the whim of US. Same thing for Singapore. Right? A lot of people complain that Singapore stock market don't move. It's because there's no fund flow here. You have to convince the American to invest here. American don't want, right? So if they pull out, then your funds get exited, your market stays stagnant. There's no volume. Okay, so you have to understand that the world is not equal one. Okay, there's racism in the stock market one. Yeah, it's true, right? The white is always better. Okay, so they support their own market, and that's what they believe, right? And they do use this, and the media also very powerful, right? They always look down on countries outside of the US. Okay, that's a matter of fact, right? They always like, oh, this is not good, that not good, because they like to impose their values on everybody else. Okay, and anybody that's different from them is wrong, right? And they are very powerful because even the media will affect how the fund flows. Right? If they paint a very bad picture about this particular country, then the fund will exit. Then when the fund exit, it will down the markets. Can see, right? US is still very, very powerful, right? Not just militarily, but in terms of dictating where the funds will flow, and they will affect financial markets all around the world. And not just that, also our USD, right? A lot of things in the world is denominated by US dollars. Okay, and especially when they raise interest rate, lower interest rate, USD strengthen, weaken, all these will have global impact. Right? For example, if they strengthen the USD, okay, or they don't really strengthen, they don't control forex. They raise interest rate, USD strengthen. Okay, how does it impact Singapore? We're so far away, 12 to 16 hours away. How does it affect us? When US raise interest rate, how does it affect us? Right, they've been raising interest rate, right? That's what they did, right? How does it affect us? How does US interest rate got to do with us? Anyone? Our interest rate up also, but why? But we don't control interest rate, okay? Because we peg our Sing dollar to a basket of currency, right? Definitely, we don't know what the currency, but we definitely know it's major trading partners, and US dollar being the global dominant currency, Sing dollar will be very closely linked to US dollar. So when US dollar strengthen, we need to strengthen Sing dollar, right? And then we'll inherit their interest rate into our little sunny island. Okay, all right. Then the next thing is that talking about Singapore, right? I don't know whether you all notice lah, okay? Or maybe ask you a question. If China slow down, right, is it good for Singapore? A lot of people hate China. Yeah, China should just go and die. If China slow down, do you think it impacts Singapore? Yes, okay. I don't know whether you notice, a lot of, especially the manufacturing stock, like your AEM, all this, right? Why suddenly sell down so much, right? Why results so bad? Because China slowed down. A lot of the companies here depends on China because China is our biggest trading partner. If China slow down, Singapore will slow down. So can you see Singapore also reported this year GDP growth will slow down. So if China is down, Singapore is down. It's as simple as that. So in terms of monetary policy, we are linked to the US. In terms of economic policy, we are linked to China. Don't ask me whether that's the best way to do things, lah. Right? I'm not my pay grade, okay? But what I'm trying to tell you is that this is the situation, and whatever happened to the two big countries of the world, it will have worldwide implication, including in Singapore, as well as all the companies. So a lot of people say that, oh, I just invest in Singapore company, I don't need to meddle, I don't care about all these international affairs. It's not true because a lot of the companies is reliant on how these two countries play out. So all of us are involved in their tussle for power. Okay? Yeah, so you can't run away one. Your nanofilm, your AEM, your micromechanics, all these manufacturing companies very, very dependent on China. Okay, if China don't improve, this company will improve. Simple. Of course, there are those hyper local ones. Like your construction company, they are fine. They don't have connection with China, but they do have impact from the monetary policy because they borrow money. Construction companies are usually more highly geared, so they will have higher impact on the interest rate. Right? So you need to see some of this relationship, how you trickle down. Right? But as I said, usually macro is a bit harder for a start. Okay? But what I'm going to explain to you here is that there is impact and there's relationship. Just that most people don't know, or they don't understand, or they cannot see the connection. Okay? Can I? Then the next thing I want to probably drive home is if you are looking at growth stock, right? If you are a growth person, investor, what are the markets you should choose to invest in if you are a growth investor? Okay, let me choose another page. You draw again, huh? You can understand my drawing, right? Okay. If you're a growth investor, yes, choose US. Yes, I would say China as well. Okay. Why not Singapore? None of you choose Singapore. Why not Singapore? Why not Singapore? Why not invest in growth stock in Singapore? You mean Singapore got no growth stock, eh? Okay, correct. Market too small. So it's not suitable for growth stock. The runway very short. And then the question is that why this countries okay, right? 300 million people. This is 1.4 billion. This is 5.5 million, right? You're saying market small, right? Okay, but why US okay, but China, some people say no growth, but the population is so much bigger, market is so much bigger. How to answer that? Okay, so the answer is that it's not just the big domestic market is important for growth. Okay, but ability to go overseas and expand is very important. Because any company eventually will run out of market. You need to keep expanding overseas in order to grow, right? That's common logic. Okay, but why does a country with a big domestic market is more likely to expand overseas and create the MNCs? Why? Because you think about this, right? The people in the same country, right? It's not just a huge market that you need, right? You also need another criteria which is called homogeneity. Okay, that means the consumers are more or less the same. So which means these 300 million people are more or less the same. Okay, it's a huge market. You do generate a lot of money for them to expand overseas. Same thing for China, they are homogeneous, right? Especially in the coastal area. Okay, so they generate money for the company to expand overseas. In Singapore, the market is very small, so you generate a little bit of money. How to go overseas? You can see, right? So it needs to be big and homogeneous in the domestic market in order for the country to have the capacity to create MNCs of the world. Small countries are just harder, not impossible, but much, much harder, right? Because the firepower very little. Okay, that's the idea. So growth stocks, you must find big homogeneous countries to hunt. Okay. Next thing, if you are a dividend investor, you like dividends, you like to collect passive income, where should you pick? Where should you pick? Tax-free place. Okay, Singapore. All right, some say Hong Kong. Okay, correct. Why? Because US got dividend tax of 30%. It doesn't make sense. And usually, US company don't like to pay dividends. Precisely because of tax consideration, they prefer to do share buyback. Okay. In China, there's also dividend taxation, 10%. It's actually 20%, but they give discount, perpetual discount. Right? Hong Kong has no dividend taxation, Singapore has no dividend taxation. Generally, Commonwealth countries, areas have no dividend taxation. Then their dividend yield tend to be higher. Okay? But if you ask me, Singapore will be the best place because you don't have forex, you have minimal forex risk. You receive it in Sing dollar. Okay, Hong Kong is pegged to US dollar, so you have some forex fluctuation, right? Because if you are thinking of dividends, likely you are using the cash flow to maybe fund your expenses or what you want a bit more stability, right? Rather than introduce more moving parts to it. Okay, so Singapore is best place for dividends, right? Where is the best place? If you're a value investor, buy low, sell high, buy undervalued stock. Once they go up, sell for good profit. Where do you hunt your stocks? US, 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 or US. If you ask me, okay, the value stocks are generally found in Asia. Why? Precisely because Asia is cheaper, ma. Remember we said already, right? for the same kind of stock in the US, they will mark up the share price, right? Because the market is more vibrant, right? It's better that you go and find a growth stock. Okay, value stock, not say don't have, it's just harder to find. Right, just harder to find. Asia, you can find a plenty of them. Okay, right? So that is also how the macro can affect where you operate and how you should go about selecting your stocks. Okay. Yeah. Right. So then it's back to this, right? So I told you already, there are like many different strategies out there. You need to know what is it for you. Some people do value, some people do growth, some people do dividend, and all this does affect how you decide where to invest. That's where the macro comes in, right? That's where the market has a very big say on whether your strategy is going to work well or not. Like for example, if you try to do growth in Singapore, it's not going to work very well. Okay, the market just doesn't give you that kind of potential for that strategy. We also talk about ETF. ETF make things simpler, right? Because you don't need to pick the individual stock. You can just buy the whole market. It has a self-rejuvenation system. We will reject lousy stock, add in the more powerful stock in the index itself, and you just do nothing, right? You pay a management fee to handle this for you, right? But that said, you still must choose a broad market index. Don't go and choose it too narrow, especially if you want to hold it over a long period of time. Okay, low cost, and stick with the major economies where their potential growth of GDP is still there, right? With the GDP growth, then the ETF will grow in value. Okay, and at the end of the day, you have to ask yourself, right? What kind of strategy suits you? If you don't know, it is in fact really like a buffet. You need to probably learn more and understand more. And just now we also talk about individual stock, okay, where you need to have both qualitative as well as quantitative analysis and try to be more balanced in your view, right? Not just based on a few surface level decision making process and then you just close your eyes and buy, right? You need to have to develop a better understanding. The purpose of doing that work is to develop better understanding, understand the risk and where the potential reward can come. And with the better understanding, will give you a better conviction. And markets will crash once in a while, right? You need to differentiate whether is it a permanent problem or stock will crash. Okay, is it a permanent problem or a temporary problem? Okay, if it's a permanent problem, you need to have the courage to sell it even at a loss and move on. If it's a temporary problem, then you can hold it, and because of the conviction that you have developed, it makes you having that ability to hold a stock and not make the wrong decision at the wrong time. Okay, so all this come together in a sense that of course the devil is in the details, and hopefully today I give you a better understanding of what's going on in the investing world. All right, it's definitely a lot of things to understand, and you do need that effort lah. Okay, I won't say that it's very easy and you can just do it as and when you like. Of course, there must be a bit of interest in there. Okay, otherwise it can be very challenging for you to achieve success in the market. Okay, it's a lot more complicated. Ultimately, you must remember, right? Majority of the stocks out there, right, is not worth investing in, and you need to be more stringent than what you are used to. All right. And I will just give me some time for advertisement. Okay. See, there's actually a lot of things that I try to present. All right. But I thought I wanted to do something that is a little bit different today so that you get your question addressed. All right. And I just for those who really want to embark on this journey, you want to learn more, this is the program that I run. It's called the Intelligent Investor Immersive Course, or I3. Right? It's actually more than a course, it's a program. So we will spend definitely more time together. I have a lot more things to share with you. And in fact, I shortcut a lot of things today. It does give you quite a good overview of what we are going through for this 6 intensive session. So the first session, I will share with you a strategy which is more value in nature, right? Buying undervalued stock. How do you value a stock to know that it's really undervalued, and when do you sell them for profit? Then the second one is growth. Right? How do you select the growth stocks, say in US, in China? What do you look out for? How do you value them as well? And with these two strategy, right, like I said, then you understanding them, then you have a better feel which strategy is better for you. Okay, later there's actually another strategy which I will share with you, right? So, but the course will focus on these two strategy as the base. And we also will talk about portfolio management, how many stocks you're supposed to have, what is the position sizing, and ultimately, after you have learned all this strategy, how do you find the ideas in the market? Okay, so we'll wrap up the 6 sessions by looking at the actual stocks, and I will share with you, right, what I think are the likely opportunities that we can explore at that point in time. Okay. So this is like a map we're going to do, right? So what I haven't go through today with you is that even within a company, there's this life cycle. Okay, so there are young companies, there are old companies, there are mature companies. How do you analyze them is also different. Okay, the kind of stock, right? Value, dividend growth, right? They belong to different life cycle of a company. So there's more things to go through, definitely. And we will provide you with a more step-by-step process, right? So that you won't get lost. So today, it sounds a bit like I'm all around the place because I didn't follow the process. I was just answering your question wherever there is. Okay, and I'll skip some of these slides so to make it faster, right? So basically, the I3 program will consist of the 6 session course. And of course, after the course, right, I don't expect everybody to be very good with investing. Okay, definitely there will be a very big improvement. You will have usable strategy that you can implement. But I would think that, especially the macro part, which I share with you, right, is almost not possible to learn it right away. Okay, it also took me many, many years to learn, right, to understand the macroeconomy, the global markets, how do they link up together in a certain way. And that's why I will have this mentoring session once every 2 months. I'll do a live session. I will update you what I see in the market in terms of the economy, in terms of the markets, right? Actually, I didn't tell you my view yet. I forgot to tell you my view just now when we talk about the macro side. Generally, I think that the stock market is more on the bullish side than the bearish side. But I also think that the correction is imminent, right? Which is quite consistent with what most of you have been talking about just now, right? When I did a survey. Okay, so I'll give you all views like this. Of course, I'll back it up with why, right? Today I don't have all the materials and the time to explain to you, right, why I think so. Generally, it should be still bullish at least until end of the year. Okay, there are statistics why I think so. Just that I don't have time to show you today. So during mentoring session, this is what some of the market analysis that I will do for you, and also will share with you some of the stock ideas that I think, hey, look at this. And more importantly, is like I know that everybody is busy. Okay, to ask you to really go and dig financial statements, go and do some valuation is almost very difficult. Even after you learn, right, I can tell you majority of people may not have the time to do so. And but to understand the strategy and how to invest in stock is important in the first place, because if you don't even have any foundation, right, whatever I explain to you, you also won't understand. Okay, so during this mentoring session, you'll find it useful if you have the foundation, and then you understand what I'm trying to say, and then you see, okay, I think this stock suits me, I want to buy, right? Then you take action on it, right? That's fine. So basically, I want to reduce the work that's required on your side. Okay, but at the end of the day, you have to make the decision yourself. Okay. Yeah, so these are some of the summary, macro summary that I did. For example, yeah, just like I told you, right? June last year, the commodity prices start to fall already. Okay, I said inflation has peaked. right? This was a screenshot of the slide last year. Okay, and I said market lead the economy, right? Exactly what I said just now, and indeed the inflation start coming down. Okay, inflation has peaked in June. Then this was March this year. Then I said interest rate likely peak already. I say stock should be bullish. But at that point in time, a lot of people still don't believe the stock is bullish. Okay, it has very ran from Jan to March quite a bit. But a lot of people think, yeah, no, it's a day cap bounce, it will come down. But end up it was really very bullish even until now, right? And I say that economy is not equal to the stock market because recession doesn't mean it's bad. Okay, so these are the macro views that I give, and so that you guys can make a better informed decision what to do your portfolio, right? If the risk is high, don't need to be so aggressive, right? Maybe slow down investment or keep a bit more cash. If the market is bullish, then maybe you put in a bit more. Then that would help you get more returns in that sense, right? Rather than miss out completely. Okay, so these are some of the trade ideas. I started this year. So this year is 2023, right? So I gave 23 trade ideas at the start of the year. Okay. So then at the point I also talk about some of the big tech still cheap, right? Amazon was 95, Alphabet was 92, Airbnb was 98, even Capital DC was 185, now it's $2 plus. Okay. Yeah, so some of these trade ideas that I will share on a mentoring session as well. So if you missed it, every mentoring session is recorded. You can always play back if you want. Okay, so you will not miss those important sessions. So that is mentoring session, and it's for life, right? So once you join this program, it's lifetime. And because we think that investment is a lifelong journey, it's not something that you do this week and then you forget about it next week. Next thing is about valuation, right? So I'll teach you how to value stocks, okay? But I also know that most people won't go and punch calculator or use Excel spreadsheet, right? After they learn already, you just leave it there. But at least you understand how the valuation is done is more important. Okay, so what we do is that we will basically download the data for you, and so that you don't need to compute yourself, right? So there are a lot of metrics, and there are 13,000 stocks. So we look at US, China, Hong Kong, Singapore. Yeah, altogether more than 13,000 stocks. It's up to you, right? So if you want to zoom in on a particular country, you want to zoom in on a particular strategy, go ahead. Okay, we just give you the data dump. There's no subscription required, and it's for life as well. The next one is watch list, because when you hear 13,000 stocks, it's very intimidating, right? Okay. So we will ring fence it for you, right? We have probably done a layer of like filtering. Of course, not all stocks, even in this watch list, is buyable. But at least it reduces to about 500 stocks, right? Something that's more manageable, right? And also put in the valuation so that it's easier for you to see, right? Oh, which one is undervalued, which one is overvalued. So you don't need to crunch the numbers. But all this valuation range, all this is what I'll be teaching, right? So you can actually see the workings, the calculation, how this was derived, right? So with that knowledge, you know how it's done, but you don't need to crunch the number yourself. Okay. Then there's also value and dividend stock. Watch this, that for people who are more value focused or dividend focused, you can look at this watch list and you realize they're mostly in Asia, right? So that's why I told you that value, dividend, usually Asia. Okay, growth, usually more US, China, all right? So you see more US here, right? But there are some China companies as well, okay? So that's how the characteristics are. So you get access to all these watch lists and stock valuations as well. Okay, and I'll update periodically. And the next is also on the qualitative analysis. Just like I shared with you, right? How do you analyze a company like DBS? We talk about digital banking. We talk about their stickiness by being a government distributor of funds. Okay, it's very powerful. And I'll share with you more of these companies, how to analyze them, because not everybody will pick up the key things of a business model and maybe competitive advantage or mode, market share, all these kind of things. I will share more of them and give you the analysis right on the right up. Okay, whether China, US, Singapore, these are the markets that we look at. Okay, so they have a better understanding and easier for you, right? You just read and you see whether you agree with the analysis or you think that you can add more thinking to yourself and look at the business in a different way as compared to before. And all this will be kept in the archive, and you can look at them, find any stocks that you are interested in. Of course, we don't cover every single stocks that are probably in our radar that we think are worth looking at, and that's where you can get some of this quantitative analysis. Okay, so you get access to the archive as well. And these are trade ideas, which means that I walk my talk. So which means whatever I share with you, I teach you, right, is what I do. Right? It's not that I do differently from what I teach. Okay, so there is a lot of alignment with the way that I share. All right. So I will just talk about, hey, I think this looks interesting. So I share about this was CrowdStrike. This was July, right? I think flat didn't go up, didn't go down. Arista in May, this did well. Okay, so these are the ideas that I will share when I spot something. It may not necessarily be on a mentoring session, but it can be trade alerts like this, right? MSCI, this also done well, right? So so far, this market has been good for us. So trade ideas and alerts will also be shared with you. Okay, and there's also our portfolio to show you the stocks that we invest in, right? That we are holding. Majority are growth stocks. There are some value stocks, and I didn't share about more about this momentum today because I have no time, as well as the high risk high payoff investments, right? So generally, but understand majority are still growth and value, and that's the core strategy that we teach in the class as well. Okay, then this is the insider vault. That is where we house all the watch lists, the portfolio holding, the stock write-up, the data. Okay, I think the data is below. Right, you can see the data. You can download the data anywhere you want. So this is like a archive of anything that you need. You can just go there as a resource, right? So a lot of all these are handcrafted by myself. Okay, so you don't get it anywhere else. Okay, so that's a bonus number 8. And there's a money back guarantee as well, because I don't know which level you are at, and I don't know whether this is something that you will be suitable for, and you also don't know, right? Yeah, you don't get a rough picture of what I'm trying to share over here. So we are going to give you this money back guarantee. So how it works is that you enroll for the program, and you can come for the first 2 sessions. You'll get a very good understanding how the strategy is like, how it's taught, whether you understand or not. So if you don't, you can ask for money back, and we return you your investments. All right. And to help you get better, we are giving you limited time bonuses. So I'm giving you 3 more bonuses if you sign up within 3 days. Okay, the first is this Growth Dragon investing course. This is China Primer. Okay, so China investing is very different, right? So a lot of the real estate crisis, all this, we are not impacted. Okay, maybe 1 or 2 is more indirect, but it's very minimal impact. There are things to look out for when it comes to China investing and where to find the information. Okay, so this is a primer for that. Second is personal finance masterclass. This is conducted by one of the co-founders of Dr. Wealth. So he's a finance professional in the industry, and he will tell you the ins and outs of financial planning. Okay, so the purpose is to let you understand how this is done so that your advisor don't smoke you. Okay. And this is the momentum strategy that I talk about. This is mainly done in the US market. Okay, because US market got a lot more liquidity, and actually this momentum strategy has done very good for us this year. Right, we also hop on Nvidia. Okay, so this strategy is very good for you to tap on any theme. Right, so just now one of you talked about thematic investing, right? So you don't even need to know what theme is hot. Okay, the momentum will fish out the stocks for you, and then you just ride them until the trend reverses. Okay, so it's a very interesting strategy. Most people don't have exposure to this, but we will give you this one of the 3 courses over here. Right, these are all courses. Okay, so they are recorded, which means that the moment you sign up, you will get access to them. Okay, so to repeat, to make sure that you understand what you're getting, this is the I3 program. It's very comprehensive, as you can see over here. This I3 course, this is the 6-session course. Okay, the dates are here. All right, it's in actually this month, next week, 2 weeks later. Okay, they are all live session like what we are holding today, right? So it will be 3 to 4 hours each session, and then for the face-to-face is a full day. Okay, the rest are webinar, right? So these are the dates. And the mentoring session for life, okay, once every 2 months, you will have another live session with me. I will share with you the market updates as well as the individual stock analysis. And there's a stock data, which you don't need to subscribe separately. Okay, so you can just get the data down and you can find the data that you want, and you get this on a monthly basis, okay, updated monthly. But the fundamental data don't change very fast, so it's fine. And watch list and stock valuation also for life, right? So you can see the watch list is narrowed down to about 500 stocks, both growth and dividend value stocks, right? About 500 of them. And you conveniently find ideas from there, right? I already filtered out for you already what are the stocks that are worth looking at, because majority aren't. Okay, so you can see, right, 13,000 down to 500, right, which means more than 10,000 stocks are not even worth looking at. Okay. Stock analysis and archive. Stock analysis archive, this is where you get the qualitative analysis. Trade ideas and alert, this is when I say I buy. Yeah, just like I did show, right? Yeah, right. So I say I bought, okay, at what point, at what price. Okay, so that's where you can get the idea as well. So there's skin in the game, basically. So there's a real money portfolio. It's not some paper money portfolio, right? It's real. Okay, so which means that if we are wrong, we also suffer financial consequences from that. That's the skin in the game that we talk about. And there's also this vault that combine all these things together in one convenient place for you to access. It is also mobile friendly, so you can use your any mobile device to find quick information as and when you want, and convenient for your access. And if you sign up within 3 days, we will give you these 3 limited time bonuses. This is a Growth Dragon course and the Personal Finance Master class and the Momentum Trading course. Okay, so you can access this information before the live dates. Okay, I would suggest go through 1 and 3 if possible, right? Or at least 3 lah. Okay, at least the third one, right? Before the session, before the live session. It is not a prerequisite, but it's better. If you have the background, then you might be able to learn more during the live session. Okay, so let me tell you about the investment, right? As you can see, this is a very comprehensive program, and this is also a flagship program. And I also give my personal number to the graduate from this program. I cannot take in a lot of people, and we give a lot of value as well. A lot of all these things are lifetime, so you don't expect this to be a cheap cost, okay, or a cheap program. So the usual investment is 5166, but we'll offer you at 4066. This is all in sync, and you can break it down to 338 per month for 12 months, and that's it. Okay, there's a money back guarantee to make sure that this is suitable for you, right? You attend the first 2 sessions, you feel that it's not suitable for you, you can ask for money back. And there's no upsell, there's no cross-sell, nothing. Okay, so because we also know that there's a lot of practices by a lot of other trainers out there, they will sell you something cheap, then they will upsell you more later. We don't have such things. Okay, so you invest one time, you join us for life. Right? We make it a lot more transparent and clear upfront what you're gonna get. Okay, if you're interested, there's a link in the comment box. You can just click on it and leave your contact, and we will get back to you. Okay, so you don't need to make any payments today, and you just sign up within 3 days, you get these 3 bonuses. Okay. All right. So this is what I have for you. I hope that today has been useful. I tried to answer as much question as possible. Right. I hope I addressed majority of your question. It's impossible to share with you everything I know within 1.5 hours. Right. So hopefully we have this opportunity to go through this in future sessions. Right. In the mentoring sessions that I hold once every 2 months. Right, so that you get this regularity of it. Okay. Okay, Melissa, I have a question. Can I use SkillsFuture credits for your training? Unfortunately, no. Right. Recording for this session, you can email admin@drwealth.com. Okay. All right. No further question. Any discount for past? Oh yeah, okay. Forgot. If let's say you have attended the Growth Dragon course, personal finance course, or QMT course, right? We will less off the amount you paid for these courses. Okay, so yes, actually. Can split installment to 24 instead of 12. I'm not sure about that because this is usually coming from the bank. Okay, but you just leave your contact. We will help you find out for this lah. Because personally, I'm not clear whether is it possible or not. I don't want to promise you anything. Maybe I can ask our staff about it. Right? They can find out for you. Okay, if not, then I think that's it for today. Our market open already, US market open already. So I need to take a look. Okay, so thank you very much for attending today's session, and hopefully it has been useful for you. And hope to see you, of course, at the program. Thank you very much, and good night.